Hey, welcome to That Is the Week. This is Keith Tier on my own today because Andrew Keane is on the East Coast visiting his daughter's university campus. So this is a solo effort, but with a difference. What we're going to do today is simultaneously host a Twitter space. The Twitter space is, if you go to KTEAR, K-T-E-A-R-E on Twitter, you'll see a link to a live Twitter space which will allow you to join and, if you want to, ask questions. Um, um, Maybe even the audio will come through. Let's see if that works. That's a bit of an experiment. This week, we are talking about venture capital. Mhm. That was the week newsletter this week. It's titled Should VC Be Public? Which is a question uh, begged in a way by an editorial in this week's The Information, where they hinted or rumored that Andreessen Horowitz might become a public company. Now, if you understand who the Information are, the Information is Jessica Lessin's publication with a great team with consistently fantastic insights and writing based on lots and lots of Silicon Valley relationships. So this is not a publication that speculates, at least not often. And when they write something, there's usually some underlying information backing it up. So when they write this week that, and we can look at it, when they write this week that Andreessen Horowitz might go public, they make a number of points. Firstly, that it's never really been possible for VC firms to go public because they're too small, but that a public listing would accelerate the expansion of A16Z that's been underway for the past 3 years, that has led to them having now 70 staff, which is a 170% increase. And they go on to talk about how the precedent in private equity, Blackstone and others, KKR, Carlyle going public, proves that the markets will accept asset holders or managers as public entities. And that it gives a whole new way for cash to flow to A16Z and allows A16Z to become what is called permanent or evergreen capital. Now, just to define some of these things, permanent capital is used as a phrase in contrast to venture capital. The way venture capital works is funds raise a capital, takes a period of time. If you're Andreessen Horowitz, it takes a few months. If you're a new venture capitalist and you're successful, it might take a couple of years. You raise money and you start to deploy it in year one, and normally the fund has an end. It's a closed-end fund, defined normally as 10 years with 1 or 2 years extension where needed. And then it's done and all the proceeds are distributed. That's venture capital. And the results of the profit exit the venture capital fund. 80% of the profits go to the original investors, typically, and 20% go to the managers, typically. And then the balance sheet shows zero at the end when the fund closes. Permanent capital, on the other hand, is a different animal. It's when the venture capital firm raises capital by selling equity. It invests from balance sheet, that is, say, not from a fund, although it can also structure that balance sheet money as a fund if it wants to. That's what I was part of in ADV in the UK. We took money onto our balance sheet, and then we created a fund underneath the company that allowed other parties to invest at the fund level. So they could do that, but certainly at the top, there's a company with a balance sheet, and the money comes from that balance sheet. That means that when profits are made from investing, the profits return to the balance sheet and are 100% retained at the company level. and can be reinvested in new cohorts. So you can have funds that roll. They start. They're not really even funds. Companies that invest that have rolling capital, and after a certain amount of time, if they're successful, they'll be entirely self-funded, and they can also use their balance sheet to raise debt or other instruments. So clearly, permanent capital is kind of interesting, especially in a scenario where you want to invest in long bets that take more than 10 years to mature. If you think about Amazon these days, Amazon is, um, you know, several decades into its life and is still growing, and its stock is still reflecting that growth. And if Kleiner Perkins, the original or one of the original investors, had been able to maintain its stake and reinvest its profits over and over again by staying in Amazon and little by little selling to fund new cohorts, Kleiner Perkins would be a very different animal today than it currently is. So in that sense, it isn't shocking that Andreessen Horowitz might go public. It isn't shocking at all. In fact, one wonders why VC hasn't thought about this path before. Now, this news is allied to last week's news that Sequoia is restructuring its fund into what you could think of as a mega top company that is the holder of all the underlying assets, whether funds or direct investments. It doesn't really matter. But in Sequoia's case, they've said that they are not planning to go public. And so, when you think about it, there's a lot in common between what Sequoia is doing and what it is implied that Andreessen might do, which is that they're both putting in place a top company, and the top company is the ultimate destination for any profits derived from their investing activities, and because of that, the potential to reinvest rather than distribute becomes possible. In the case of a public entity, the shareholders have a liquid asset sitting on top of those assets and can choose to buy or sell at any time. So it's and by the way, also very important, the public can invest because it's a publicly listed entity. So the current rules that prevent ordinary investors from investing in early stage companies due to what's called the accredited investor rules, which are all pervasive globally. Those rules don't apply because once you're a public entity, anyone can invest in you. And so the potential opens up for capital to flow into let's say, Andreessen Horowitz from, for example, Robinhood investors, opening up billions of dollars of ordinary people's money to be invested in early stage venture, but not in a reckless way, but by putting money into the top performing fund managers, which of course would be fantastic for everyone involved. Really, the only losers really would be the middleman, which is the money managers, endowments and pension funds and so on, that would now have to compete for access with everybody. With everybody. So just my take, that would be a good thing. In the case of Sequoia, they've declared they're not going to go public, so entry into their top co will still be restricted to accredited investors and in practice to large fund allocators like pension funds and endowments. And there's an argument that that's okay because pension funds are managing ordinary people's money, endowments are managing education institutions and other money, and family offices are managing legacy money normally. So, Sequoia is making a profit for those entities, but liquidity becomes subject to whatever Sequoia says it is. And so you don't have the benefits of the democratization of investing. Neither do you have on-demand liquidity. So in both cases, the Sequoia model is what you could think of as a walled garden or a closed model, whereas the idea of a publicly listed fund company, I keep using the word fund, we should get rid of that word. It's a publicly listed investment entity, more like Carlyle or BlackRock or the others that have taken the public path in private equity. That approach is, in my view, superior. Now, just to get some things straight, this is a rumor about Andreessen Horowitz, not a fact. I'm guessing that it's a well-researched rumor, so there probably is fire where there is smoke, and we have yet to see. Now, what could be driving this? What would be the thing that is driving this trend? We've talked a lot on That Was the Week about the changes in the venture capital ecosystem, driven by the move towards growth investors investing at scale, rapidly and earlier than was traditionally the case. And here again, it's worth contextualizing a little bit historically. And to really understand this, you have to go back to the bubble bursting in 1999-2000, when, for all intents and purposes, in Silicon Valley, the next few years were called the nuclear winter. To all intents and purposes, venture capital stopped investing. Not entirely, but for the most part, risk was not something to look forward to, but was something to run away from. And most of Sand Hill Road slowed down, significantly slowed down. By the time Michael Arrington and myself created Archimedes Labs in 2005, and TechCrunch was born a few months later in June 2005, it really was the case that as Web 2.0 began to grow and companies like YouTube and Pandora were born, those founders were coming to the TechCrunch house in Atherton and pitching, stood on sofas using laptops, to an audience of angels. And there were very, very few investors in the room that were Sand Hill Road representatives, because they literally weren't playing that aggressively. And into that vacuum came what today we know as the seed funds. People like Ron Conway at Silicon Valley Angel was very aggressively started investing in that time frame. I remember Jeff Clavier, now at Uncork, began investing personally and then eventually created his first fund, known as Softtech VC. You got a whole bunch of entrants. Y Combinator and 500 Startups came to life shortly after that. And a new early stage investing ecosystem was born, which today we can call the seed ecosystem. And it's quite distinct from the old venture capital that predated the bubble bursting. As that matured and companies were born, the most important being Facebook, growth investing was born. When Yuri Milner from DST Capital in 2010 invested, I think if I'm remembering rightly, it was $100 million into Facebook at a valuation of $10 billion, along with Microsoft. That was the first evidence that a growth investor able to write a decent sized check, being less concerned about short-term valuation and more concerned with long-term outcomes, could win deals against established venture capitalists, and was very successful doing it. In 2010, that marks the starting point of the trend to growth investing. And growth investing is really risk-averse investing into what at the time it would be perceived as a sure thing. And again, is not really the same as venture capital. And the history of growth investing is its own history, but it culminates in the more recent era with people like Fidelity and BlackRock, and now Tiger Global, Coatue, Insight, and others, playing the same game of aggressively investing and coming earlier and earlier, sometimes now in the A round of a company, So you really have two, brand new asset classes within venture: the seed asset class and the growth asset class. Andreessen and Sequoia are kind of uncomfortably sitting in the middle, trying to spread their tentacles to both sides whilst playing each side. And for the most part, are looking more and more like growth investors and less like venture capitalists. And as the growth investors come earlier, venture capital, defined as what it historically has been, ceases to exist. It's redefined as an entirely new thing. And because the people who play that game well command enormous assets, in the case of Sequoia, $45 billion. I don't know the number for Andreessen, but it's a very significant number. The potential for them to stop being fund managers and become company owners with assets is real. And how they do that, whether they go public or create a top co like Sequoia or some other method, is an open question. What is really interesting is that path is not available to the average venture capital fund because it's simply too small to do it. And it's certainly not available at the seed stage. So taking a pause and standing back, these two developments by Sequoia and Andreessen, if it's real, are not a surprise, is entirely consistent with what you would expect to happen, and almost certainly is the start of a trend which will evolve over the coming period. So somebody in the chat is asking, how does going public impact LP structures? Thanks for that question, Julia. Well, LP structures simply go away in this scenario, but you still have, when I say that, I mean, they're not LPs anymore. LP stands for limited partner. That means there's an LLC that they're a member of, and they have units of ownership in that LLC, and they have a call on the returns from that LLC. In these structures, they become equity shareholders in a new entity. And as an equity shareholder, they don't have any preordained right to dividends or distributions of any kind. Their asset value is enshrined within the price that the shares they hold command. And that price, of course, is a function of the underlying assets value and the growth rate of the underlying assets, just like any company that's public is measured by two things. The current value of the company, usually measured in revenue, but it can also be measured in asset value. And whatever the form of value that the entity owns, the absolute size of that is the baseline for valuation. And then the rate of growth, it gives you an indication of the multiple that you might be able to attract to that value. And so if your assets are growing 200% a year, then you're going to get a different valuation than if they're growing, let's say, 500% a year or 20% a year, because the multiple of your base value will be different, because the market always values the future, not just the present. So LPs go away and they become shareholders. Now, as a shareholder, they basically keep 100% of their profit, not 80%. They keep 100% of their profit, and their capital that they staked is their basis for continuing to keep that. And they don't just get 20%. They don't just get 100% of their profit, in one cohort. It's permanent. If they keep holding the shares, they keep getting more and more. So in that sense, it can certainly be modeled very beneficially to what it would formerly have been an LP and is now an equity holder. At the same time, the fund itself keeps 100% of its upside. And so it can, when it makes exits, retain the capital and reinvest it in the next cohort, thus helping the equity shareholders as well. So as a structure, it does very well. Now, obviously, from a tax point of view, it's treated differently. Um, and I'm not a tax expert, so I'm not going to deep dive into that. But certainly, capital gains tax will be available to equity shareholders, long-term capital gains if they hold long enough. And it's possible that within a corporate structure, as an asset holder, um, uh, profits derived from successful investments will be subject to corporate tax. There may be ways that the lawyers can figure out where it's also capital gains. I don't know. But I'd say those are minor points in the big picture because the overall approach seems very well. So let's take a deep breath there and pause just for a second and ask a second question, which is if this is happening, and if venture capital is going to be at risk because this approach will take over the industry. That's something that, for example, Sam Lessin has been arguing on his podcast and also in the information, that venture capital has to, in a way, accept defeat and move to areas of focus that are not of interest to the big players. And so try to, if you like, game the system by surviving on the edges, is the way I think of it. I entirely understand that thought, and it, certainly tactically can make sense for an individual fund to do that. But if you're looking at this at the macro level as an ecosystem and an asset class, the question arises: who's left standing through this process? And the truth is that the seed asset class is left standing. Why? Well, because nobody, and I really mean nobody in the growth side, knows how to or would want to take the risk with seed stage investments. Being able to select from large numbers of candidates a small number of investments is a specialist skill. It can be very specialist, as in a fund, a seed fund could focus, for example, on biotech, and is likely to be highly specialist in its ability to do that. It could focus on hard tech or deep tech, as it's sometimes called, and be very focused in its ability to do that. Or it could be focused on SaaS, like say Point9 is in Europe, or Thomas Kung's that is here at Redpoint in the Valley, and be really, really awesome at SaaS investing. So the first thing about the seed stage is there are specialists. There are also seed generalists who focus on team and market segment and size of opportunity and likelihood of gaining outcomes. I'd roughly divide those people into traction investors who go in early when there's signs of life in their product market fit, and passion investors, people like Saul Klein at Local Globe, or Seed Camp, Reshma Sohoni and Carlos at Seed Camp, who are passion investors who basically have conviction in a team and an idea and an outcome. There's a lot of those who invest prior to traction and have had great success doing so, producing fantastically successful companies like TransferWise or UiPath or Revolut and many, many others. So the seed stage is immune to being victimized by these trends. It will continue to survive and could even be the beneficiary of the large amounts of capital and the rapid deployment of capital happening from the Series A sometimes, but more commonly the Series B onwards. And so the seed stage is really, really interesting. Now, the problem with the seed stage from a structure point of view is it can't really take advantage of these new ways of organizing. Why? Because each seed fund is too small to be able to benefit or even successfully achieve public listings. There are exceptions. A UK fund, I think it was Forward Partners, just went public after previously being funded as an LP by BlackRock. BlackRock then invested in them as an equity holder, and they are doing a listing. So there are exceptions to this, but they tend to be smaller plays and a bit harder, for example, for institutions to deploy capital through them. Although the BlackRock Forward Partners example is shows that there's possibilities of a kind of a patron artist relationship between institutional capital and a bunch of small funds. That's theoretically possible. I don't think that's going to happen. I think there's too much risk at the seed stage for that to happen en masse. So I think the seed stage needs a different approach. Firstly, whenever there's a lot of high value assets, and at this point it's worth going to our tweet of the week this week to give some context. Tweet week is all about the seed stage, and it's kind of interesting. So let's put it on screen and we can talk about it. Tweet of the week is kicked off by Turner Novak, asking whether any LPs have aggregated the recent performance from seed funds or emerging managers, which is another way of talking about early stage funds. And Samir Kaji, who is well versed in the seed space, answers with some examples of performance at the seed stage derived from, I think, mainly from PitchBook. And he makes the point that, the top quartile funds are doing somewhere between 2.2 and 1.6x return, depending on which source you use, which is, when looked at from the point of view of what is called internal rate of return, which is a measure of growth of value over time, it looks at roughly around 30% IRR. A bit under 30% as an average. Obviously, more recent funds haven't yet matured enough to have a good IRR. VC funds have what's known as a J curve, where in the early years they're investing money, and so they don't have yet measurable upside. And then over 10 years, the J turns upwards, and they get to some of these IRR numbers. So, he focuses on 2014 to 2018, where it looks like the average is, 27 or something like that. Terence Rohan replies to that, saying that for a sub 50 million fund, which isn't really tracked by research houses, you can assume that a good fund in the top decile is doing for every year of its life, the multiple of its 50 million is the year number. So in year one, it's 1 times, in year two, 2 times, in year three, 3 times. And ultimately, he thinks 5 to 10x is top decile for sub $50 million funds. Reshma Sahoni, who knows because she runs one, says this is absolutely right and doable over and over again. Now, what that tells you is that the seed stage asset class produces exceptional returns in the top decile. Not news to me. When I was at ADV, not to disclose any confidentialities, but we invested in a partnership with SeedCamp, a small amount of money actually, but the returns for that small amount of money over the period of time, which was roughly 3 years, actually far exceeds that 10x that that Reshma spoke about, and that was in 3 years. So the seed asset class, if properly understood in its differential, that is to say, if you create 10 segments, each segment is ranked by performance, and you look at the top segment by performance, the returns are exceptional and the gross amounts are very large. Now that's where the question of what to do in the seed area becomes actionable. The top performing seed managers collectively have market power, have a track record, and have a weight of investments sufficient to attract institutional capital, although they can't do so individually because they're too small. It's interesting, one of the things in this week's newsletter is our good friend Paul Graham. And Paul Graham comments that the top value 30 YC companies, the value of the top 30 YC companies is currently $575 billion. That's the top 30. And that is a sign of the value that can be created from a seed starting point. Now, Y Combinator typically owns 7% of a company at birth when it puts its first money in. And 7% of 575 billion is just under 50 billion. And Y Combinator hasn't maintained its ownership and doesn't have 50-ish billion of value in those companies, those top 30 companies, because it's been diluted through successive rounds down to a much smaller percentage. Still outstanding, by the way. But if it did have the capital, it would have 50 billion if it maintained. And, that begs the question, why doesn't it have the capital? Because Y Combinator is clearly, as is the entire top D side of the seed asset class, is entirely capable of making good use of unlimited amounts of capital as companies grow and prosper. So that is another clue as to why the seed stage is interesting and how it might be smart to think about it. I personally think that the aggregate value of the top performing seed managers is going to become an organized asset class open to institutional capital at scale. And I think the best thing to say is watch this space and let's see how that evolves over time. Let's wrap up with this week's Startup of the Week. The Startup of the Week is driven by the fact that, let me go to the end to make sure that we're in the right place. The Startup of the Week is Bitcoin. Why? Because this week marks 13 years since Bitcoin white paper was released, and today, as we can see if we take a look, Bitcoin's market cap. I think I can do it by just putting BTC. Yeah, there we go. Bitcoin's market cap currently is measured against 60,000 or close to $61,000 a share. It's well over $1 trillion 13 years later. And, I don't think there's any company in the world that was worth $1 trillion after 13 years. So that would make Bitcoin, there you go, 1.16 trillion. It's come down, 1.274 trillion. Still, no company has reached $1 trillion of market cap in anything like that time frame. In the past, it would have been really outstanding to reach $1 billion of market cap in that time frame for a corporation. So Bitcoin is the fastest growing asset in the history of companies, if it was a company, but it isn't a company. It's a protocol and a platform that is open source and the whole world can participate in. That, it seems to me, is quite a good startup of the week in a week where it is rumored that Andreessen Horowitz will become an openly investable entity with the public listing where everyone in the world can put money into it. And if it does do that, I, for one, will add it to my portfolio as I do think that it will do very, very well for its investors. So that, my friends, is this week's That Was the Week without our good friend Andrew. Should venture capital be public? My answer is yes, but there's lots of devil in the details there. And I will see you next week with Andrew on That Was the Week. Bye for now. See you soon.